So just days ago, Bloomberg confirmed that Aviva is going to overhaul their investment offering and double its allocation to private markets. That means they're going to invest between 20 and 25% of the value of the workplace pension default fund into private equity, infrastructure projects, and real estate. Now that's a bold move that was once reserved for institutional and professional investors with knowledge and experience, and with good reason. All that sounds really impressive until you realise just how risky it can actually be. This isn't a simple portfolio tweak. It's a huge gamble with ordinary people's retirement savings. If Aviva's investment gamble pays off, other pension providers are not just going to sit idly by, as they're also going to need to chase ever higher returns to allow them to compete. But that means that the risks are going to multiply across the pension world, because when a giant like Aviva makes a move like this, everyone just sits up and naturally pays attention. So will your pension provider be chasing higher returns and chasing headlines, or are they just going to be chasing trouble instead? So in this week's video, I'm going to be looking at whether this could be the start of a riskier era for your pension savings, just dressed up as innovation. Or will pension providers be lighting a bonfire under your retirement? So whether you've got an Aviva pension already, or you're concerned about how your money is going to be invested in the future, you really need to watch this video. If you're new to the channel, a very warm welcome. Hi, my name's Simon, and I'm a chartered financial planner with decades of experience helping hundreds of clients as well as their families plan ahead with confidence by keeping more of what they've earned.
About 5 months ago, we published this video about how the Mansion House rules and government changes meant that 10% of workplace pension default funds should be invested in private markets, with at least 5% to be invested in the UK. Now, as about 90% of us in the UK have got their pension contributions invested in their default fund, this affects millions of people as well as their retirement plans. Now, currently, these investment changes are voluntary, but if the government isn't happy with the level of investment into the UK, unsurprisingly, they've awarded themselves special powers to set mandatory targets to force and coerce pension providers to comply. Aviva announced on the 30th of September 2025 that their intention is to go a lot further. They're going to be investing between 20 and 25% into private markets in a move that could affect hundreds of thousands of savers, and is going to involve between 7 and 8 billion pounds of pension money being directed into these less liquid and higher risk investments. Now, if Aviva decides to expand this strategy across its 30 billion pounds of pension assets, then the ripple effects could eventually reach millions of their members and tens of billions of pounds in workplace pension savings. Just let that sink in for a minute. Now, Aviva's new default strategy has been branded My Future Vision, and it replaces the more traditional My Future Focus for some workplace pension schemes. So this is not just a simple tweak, it's a big shift to higher risk and more illiquid investments. And I'm sure that Aviva is going to argue that their idea seems simple. Now, private markets can deliver higher long-term returns. They can also offer inflation protection as well as diversification at a time when stock markets can be volatile and returns can be modest. Now, Aviva also points to its alignment with the Mansion House Compact Accord. And this is where the government is pushing to channel pension money into infrastructure and growth projects. Now, with the mandatory digital ID projected to cost the taxpayer billions of pounds, could your pension pot be used to bankroll the government's IT system as well as their digital ID rollout? So for many savers, this shift will happen automatically. And that's because the majority of workplace pension members will stay in their default fund. So this is going to change quietly and increase their exposure to illiquid and complex assets, whether they realize it or not. Private markets and infrastructure projects can outperform the stock market, but they also come with higher fees, some very opaque and difficult to understand valuations, and of course, they are less liquid. So when markets stumble, these assets can freeze up, making it difficult to move money, to switch funds, to transfer them, or even to draw down income in your retirement. Now, Aviva naturally is going to insist that their strategy is carefully diversified and that exposure to these high-risk assets is naturally going to decline the closer members get to their or approach their retirement. But for anyone in their 40s or even their 50s who are close enough to retirement to feel these market shocks, this new allocation means taking on more hidden risk than ever before. Now, you all need to be made aware of this comment from a pensions expert. This move will extend the risk envelope of default funds in a way that most members will never notice until it matters and it's too late. Now, Aviva's Master Trust alone manages around £12 billion for over 500,000 members, and its broader workplace pension business covers more than 5 million people. So if this high-risk approach eventually spreads across Aviva's other schemes of roughly £30 billion of assets, then a 25% allocation into private markets could mean about £7.5 billion flowing into this very high-risk area. Now, to me, that's a huge sum of money locked up in assets that can't easily be sold. And if the competition like Legal & General, Scottish Widows or Standard Life decide to follow suit, then the UK could see tens of billions of pounds of ordinary workers' pension money tied up in these illiquid projects within the next few years. And the result is going to be a systemic shift into how retirement savings are invested, but who bears the higher risk if it all goes wrong. So before I get into the upsides as well as the downsides of this approach, if you're finding value in this video about Aviva's risky approach to workplace pensions, then hit the like button and subscribe to the channel. Now, you know the drill by now. It's free, it only takes a second, but it does help us to keep making these videos for you. Now, don't forget to hit the notification bell as well so you don't miss any of this future content. But here's a quick question for you. Should pension providers be coerced into chasing government investment targets, or should they be focused primarily on getting the best outcome for your retirement? Let me know in the comments below. Let's have a look at the upsides. Now, you do have higher potential returns, and that's because private markets often target returns of between 2% and 4% above normal stock market returns. You've also got some sort of inbuilt inflation-proofed resilience, and that's because infrastructure and real estate projects often deliver inflation-linked returns and revenues. And they can also add diversification. By adding private markets and private assets, this can actually smooth the returns and reduce your resilience on stock market performance. Now, for long-term investors, these assets can be a logical fit, but there are some downsides as well, and the trade-offs are very, very real. Let's start with liquidity. Now, private assets can't be sold quickly, and that means that members are going to be transferring, switching their pension, or turning on their pension income drawdown. They are more likely to face delays in receiving their money on a regular monthly basis. You also need to consider the very opaque valuations of these assets, and that's because private markets are often priced quarterly or annually or by request, and they are not quoted daily like stock markets are. So what that means is, in a downturn, prices may look smooth and orderly until the losses finally appear on your statement. We also have to consider higher fees, of course, and that's because performance and management charges are going to be steeper for these assets. And as we all know, that's going to be eating into your final returns. And let's not forget about political risk either. Now, if these projects underperform or appear to be politically driven, providers could face a public backlash as well as scrutiny from regulators like the FCA or even the pensions regulator. So could other providers follow? Well, almost certainly. Now, Aviva isn't just reacting to government pressure, it's also setting the pace. By overshooting the Mansion House target with a 20 to 25% allocation to private markets, Aviva is clearly positioning itself as an industry leader. Now, if they're successful, other providers are now going to face questions from their members as well as their corporate clients and trustees, and they're going to be asking, why isn't our default fund doing the same? And once one major player changes the benchmark, well, naturally FOMO and peer pressure is going to kick in. Now, pension default funds tend to cluster. So Aviva's decision could nudge the entire workplace pension market towards higher risk, higher cost portfolios. And that's why this story isn't just about Aviva. It's about what happens when government policy ambition meets your pension reality and who ends up nursing the losses if or when the economic cycle turns for the worst. So if you've got an active Aviva workplace pension or even a deferred pension somewhere, don't panic. But you do need to check where and how your money is invested. And this is what you need to do. First of all, you need to log on to your Aviva online pension account or via the My Aviva app. Go to My Investments or Fund Holdings to see your current fund. Now, if it says My Future Focus, you're in the older default fund with a 10% maximum allocation to private markets. If it says My Future Vision, you're already in the new heavily private markets fund. But make sure you also read your annual statement. That's going to list where your current default fund is, as well as the contribution split between you and your employer. But you also need to explore your options as well. You're going to be able to switch out of the default fund into other funds which might be more suitable, such as low-cost, globally diversified funds or passive index funds through your online portal. Now, switching is free in most schemes, but timing matters. So if you're close to retirement, you might want to consider moving from higher risk funds into lower risk funds. But if you want to watch more about how your workplace pension might have been hijacked by the government, I've linked another video for you to watch, and another one about how gifting your home to your children to avoid inheritance tax or care home fees might end up costing you absolutely everything. So thank you for watching to the very end and for your time and for your patience as always, and we'll see you all again next week.